Mike Maxon and Brandon Gray are partners at Simple Numbers LLC. They both have a passion for teaching entrepreneurs how to make their numbers simple. They use the CRI Simple Numbers methodology and financial modeling to elevate their clients by showing them the key numbers to make actionable decisions such as labor efficiency, return on investment capital, and salary cap. They're dedicated to helping entrepreneurs fine tune the economic engine of their business for maximum true profitability. I was lucky enough to read their Simple Numbers book. Man, 10 years ago, is that possible?
Oh,
It was a
definitely. Yeah.
Oh
long
God.
time ago. I say, is it possible? Like, then you say, no, Mike, it was just written 5 years ago. But I think I read it somewhere about 10 years ago. I share a lot of the concepts with all of my clients because they're so important. And in fact, one of my longest term clients who I've been working with, man, going on 11 years, I think, has been a Simple Numbers client. In fact, one of Brandon's clients for many, many years. So looking forward to this. Brandon, Mike, welcome to the show.
Thanks, Mike. Yeah, it's been great hearing about the changes and the things that you can make with leadership teams and getting them to the next level. And, fits in nicely to the things we talk about in terms of, you coach them up and then we get to see the outcome.
Yeah, it's so important. And I find that there are so many leaders that frankly don't even know how to read a P&L and, let alone anything more sophisticated. And not only do they not know how to do that, they don't admit to it because it's kind of an embarrassing thing. It's like being a fifth grader and having to admit that you
Yeah.
don't know how to read. So I'm really interested in digging in. But before we do, I always start with the same question. From all of your experience, and I'd love both of you to answer it. I may get different answers or the same answer. But from all of your experience, what's the one most important characteristic of a great leadership team? And Mike, since I like your name best, why don't we start with you?
Oh, I have this funny story. I say I will spare it, but it relates to why I thought about the 4 A's of Simple Numbers. I have a whole funny thing behind why I thought of this, but it has to do with conferences and all this stuff. But really, I see leadership teams commit to that, one, analyzing the business as a whole, whether it's the numbers or whatever. Then they want to get aligned on it. Then they want to take action and they want to have accountability. And those 4 things, when you see a great leadership team, that seems to resonate across the board with them, is those 4 things right there. And so their commitment to those 4 things really stand out, and you can tell if they have them, you see a good running business.
Excellent. Brandon, tell Mike why he's wrong and what's your answer to that question?
Mine would be they are proactive. So as we're on calls and working with entrepreneurs and their leadership teams, it's very easy to see the ones that are going to perform and excel in that they bring to the table problems along with ways to solve those problems and propose those to us and want to know the impact that's going to have on the numbers versus us looking at the numbers and telling them there's a problem here. And the analogy I many times give, if you take a stone and you throw it into a lake, everyone can see the first ripple, but a great leader can see the 10th and 11th ripple, the impact that that's going to make. And, it really stands out when you've got a great leadership team who will come and they'll say, hey, here's something we believe could happen or is going to happen. What impact is that going to have on the numbers? And then they bring potential solutions to that versus the ones who have no idea what's going on.
So to take both of those ideas, I guess, forward from your work with Simple Numbers and your work with clients, what do you see as being the biggest blind spots and let's talk at the CEO level. What are those biggest blind spots they have about their own profitability, their own financial health?
Couple come to mind. I would say the first is just understanding if they're healthy or not. Many folks believe so long as my revenue is going up, we're great. But revenue's vanity. It's not about revenue. I've never bought anything with revenue. I've only bought it with profit. And so that's the first one that really jumps out. The second is an understanding of what the profit levers are inside of their business. So they have the revenue, but they don't have the profit, and they're scratching their head trying to figure out why. And so the leadership team gets together and they go, well, we need to cut expenses. So they tell each department lead, hey, there's a 10% cut in your budget. Okay, well, what does that entail? What does that mean? Is that the best way of going about doing it? Is that the biggest lever inside my business? Is that the one that I should pull? And they simply don't know it, and much less know what impact just blindly going in and making a mandate or a statement like that's going to have, not only with their own team members, but on the overall profitability and what impact it's going to have with their customers or clients.
I would agree 100% with that. And to add to it, if I was asked the question first, I would have said their inability to project outside past like a month. And so they typically might set a budget, or they might even have a forecast that they don't ever revisit, don't ever adjust based on those levers and things like that. So all of a sudden, hey, things are good. Oh, we had a bad month. And then fast forward 3 months and they're out of cash, or I don't know what happened. And so those are that forward thinking or view of the financials can be a huge blind spot.
So I want to dig in to both of those answers, kind of relate them together and dig in, because when you talk about an understanding, this simplest understanding is, am I healthy or not?
Right.
And understanding the difference between revenue, profit, and cash. And to finish the quote, Brandon, you started, the way I've heard it is, revenue is vanity, profit is sanity, but cash is king.
No doubt.
Because you can be profitable, but depending on how quickly you have to pay versus pay your vendors and how much inventory you need and all that, you could be profitable and run yourself right out of business if you've got no cash left. So what I want to dig into, in that understanding of health and in that projection, and Mike, I want to do, you didn't say, and this is probably part of what you meant, but you didn't say projecting revenue. You talked about projecting cash as well.
Yes.
And what I see that really can hurt a team is, let alone a lack of understanding, there are some closely held businesses where the CEO/owner in that situation is very comfortable, usually sharing revenue numbers. But sometimes, even with the senior leadership team, there's a hesitancy to share profit and cash numbers.
Right.
And there are a whole lot of reasons behind that. But what do you see? Are you seeing that issue as well? And if so, what's the right kind of coaching and advice for CEOs? Because if their leaders only understand top line, they can't help you manage to the bottom line.
Right. It's all over the board. Like I said, there's a lot of folks we work with who we're not right, wrong, or indifferent here in what you want to share, but they're not giving the team members the information that they perhaps need. And I'm not saying that you got to have profit to be able to educate and help people understand. A term that we many times use is called contribution margin. Okay. And so think of it in terms of revenue less your non-labor direct costs, supplies, materials, those kind of things, because we want to isolate direct labor because that's an important lever in any business, and then subtract direct labor from that amount as well to get your contribution margin. We've got a ton of clients that we work with that we just share down to that level because their leadership team may not have any control of the operating expenses inside of a business. And so if they don't have any control over it, why do they need to know it? And they can't change any of the outcomes based upon it. So, you can do more damage than good many times if you start sharing all the way to the bottom line in some instances. And so for whatever area that leadership team has responsibility, they need to understand from a financial perspective, what does winning look like?
I think that one of the things for CEOs to do, depending on, again, all companies are different where how much you can share down to what level. I think it really helps when the organization sets for their positions and their people, that key number that moves the needle, right? And Brandon mentioned labor efficiency, or if you're a manager, it's contribution margin, or it could be a guy on the line and it's like, hey, how many widgets did you get through that day? I think it's setting that across the board that relates to the overall P&L. But the guy over here who might not have a great understanding of P&L, he knows that if I pass through this many widgets today, I did my job and it's going to affect the overall numbers. And so, yeah, it's great that, hey, I share we did 10 million this year, but to the team members down below, it's that key number that they can hone in on and know, hey, this is where I move the needle. This is how I get paid. This is where I get my raise. And obviously it's simple numbers. We help identify a lot of those, and Brandon did down to contribution margin in terms of for the management team. But I think for CEOs out there, I think one of the things is do your employees know their key number? Do they know what moves the needle? And then that ties to your overall financial model and analysis.
It's not about the outcome. It's about the inputs.
Yeah.
Profit's an outcome, but your team has to understand what inputs do they have control over, how do they manage those, and the importance of them.
You both mentioned the idea of labor efficiency. And I'm very familiar with that term from working with my clients on it,
Right.
getting the idea from your Simple Numbers book. But talk about that, a little, the numbers, using the numbers right. Bottom line is it should help leaders not only understand their health, but it should help them make decisions. So when it comes to labor efficiency, talk a little bit about how CEOs could use their numbers, and that one in particular, and others, bring in others as you need. But how could leaders use their numbers to better decide when to hire, when not to hire, when to restructure roles or teams? Because I would tell you, probably the most common thing I hear from the senior leadership teams I'm working with, not so much the CEO, but the senior leadership team that reports to the CEO, is I don't think I've ever seen a senior leadership team where half of them didn't feel like they were short-staffed.
Right.
And now that doesn't mean half of them are short-staffed.
Uh-huh.
It just means they always feel that way. So talk a little bit about how we know if we're short-staffed. How do we use the numbers to decide when to hire, how many to hire, those kinds of things?
Definitely. So there's two simple numbers, philosophies or components that you would say that you look at when you're making those decisions. So the first one's labor efficiency, and the second one is salary cap. So we'll talk a little bit about salary cap, and then we'll talk about labor efficiency. So probably got some NFL fans on listening, right? Given what the ratings were for the Super Bowl, most likely got some NFL fans. There is a rule in the NFL that mandates the maximum amount you can spend in total salaries. So can't spend above it. You can spend under it. They don't care. They don't tell you who to spend it on. But at the end of the day, you can only spend X amount on salaries. And a business is exactly the same. Whenever you look at the components that make up profit inside a business, you got, as we said earlier, you got revenue, you got your direct cost, supplies, materials, contractors, those kind of things. You got labor, and you got overhead. Which of those cost buckets do you have control over? And what we would argue is that you have minimum control over the direct cost, supplies, materials. Sure, you can might negotiate or buy in bulk or what have you, but at the end of the day, the market pretty much sets that. You have very little control of the overhead cost, and I would also suggest that it's typically not a big enough needle to really impact profitability. As we like to say, you can't go from 2-ply to 1-ply toilet paper and become profitable. Back during COVID, Mike, everybody's scared, right? Before PPP came along, we what's going to happen? What do we need to do? And inbox is full, and the voicemails are full, and everybody's calling you. And so I'm taking those calls, and I get on a phone call with an entrepreneur, and they'd say, you know what? We got to change. We got to save some money on expenses. I've been digging in, and we're canceling satellite radio. I'm like, okay, well, that's $19 a month. Great. We only have $236,000 more dollars to do something with. It's just not a big enough lever. But the biggest lever you have is labor in any business. And so it becomes a mathematical equation. If I have control over labor, and we're going to speak to how you measure that here in just a second with LAR. If I have control over labor, and by the way, it's the only cost that shows up every day with an attitude. Sometimes it's a good one and sometimes not so good. Then I can just calculate, here's what I'm going to bring in. Here's what I need to set aside for total expenses. Here's what I need to set aside for profit. The number left is your salary cap. And then compare that to what you're actually spending on salaries. If there's room, I can add people. If there's not room, I can't. I've got a problem somewhere if I can't. And my team's telling me, we're bleeding from our eyes and our ears. We got to have help. Mike, any thoughts there on the salary cap when we talk labor efficiency?
No, it's pretty self-explanatory. I mean, you got to sell to the labor you commit to, and if you can't, got to adjust.
Yep. So then the second metric that we look at is, well, how effective and efficient is my labor? That's a little bit of a different view of labor because most folks look at labor as a percentage. I don't know many people who like to be thought of as a percentage, right? Labor is truly an investment. When you look at a piece of equipment, we always talk about the return on investment I'm going to get with it, right? If I buy the latest and greatest piece of equipment, this is all it's going to create in efficiencies and the return I'm going to generate. Well, your team is the same way. They're an investment. And I invest in them every time that we run payroll. And in return, I expect a return on that investment in the form of gross margin, contribution margin, and ultimately profit. And so labor efficiency measures for every dollar I spend on labor, what is that labor generating in return in the form of gross margin for us? So if I put $1 into the machine, does it give me $2, $2.50, $3? And you start to watch that over time and determine, okay, where should I be at? When am I getting the highest returns? What was my team structure like then? What was my makeup like then? And so Mike Goldman, to your point, you're saying, hey, and I agree with you 100%. Most folks are saying, we need more people. Well, the numbers may tell us something completely different, that you're spending plenty on the people. You might not have the right people. You might not have the right systems, processes. And that's where we got to dig in and determine.
So tell me, what's the actual calculation of labor efficiency ratio?
Great question. So I'm going to throw a few terms out, and granted, we're on a podcast, and so it's kind of hard sometimes to visualize these. And so
everybody, pull over your car, get your pencil.
Don't ever wreck
out.
right now as you're mentally viewing your profit and loss statement. All right. So the first term we want to calculate, or the first number we want to calculate, is this term we call gross margin. And for you accounting nerds that are on, and by the way, I'm one of them, we're going to define gross margin a little bit differently than the accounting textbook does. Okay. Very simple. Gross margin is revenue minus your non-labor direct costs. All right, I want to take labor and I want to separate it, okay? So it could be supplies, materials, subcontractors. If you're a services-based business, you may have zero there. You might not have any non-labor direct cost, okay? So take my revenue less the non-labor direct cost. That gets me gross margin. All right, that basically is what's being generated to pay for my labor and my overhead. We then divide that gross margin by your total labor. We'll keep it real simple. You don't have to include taxes and benefits. Okay, just salaries, just wages. Gross margin divided by total labor gives me my total labor efficiency. That tells me for every dollar I spend on labor, what is being produced in gross margin. Once you do that calculation, I'm going to give you a data point here, okay? For 90% of the businesses out there, you have to be between a 1.8 and a 2.1 to reach your profit target to be considered a healthy business. So divide your gross margin by your labor spend. That number should be between a 1.8 and 2.1. So it tells me I get $1.80 for every dollar I pay in labor, up to $2.10 for every dollar I pay in labor in the form of gross margin.
And that becomes so important because the clients I have that use that number, the conversations they're able to have are so much more powerful where, someone, on the leadership team says, wow, we're not able to do those things because we're short staffed. We just need more people, and the CEO could look and go, wait a minute, our LER is 1.78. Last year at this time, we were at 1.9.
Uh-huh.
Help me understand why we're short staffed.
Exactly.
Maybe we're over servicing our clients. Maybe we've got the wrong people. There are a whole lot of questions. Maybe we're prioritizing too many damn things, but short staff doesn't ring true if you've got, or at least you can challenge that now that you've got a number that actually tells you what your ROI on labor is.
Definitely.
I believe that it's the ultimate equalizer of helping you ask the questions around, do I have the right person in the right seat, doing the right thing at the right rate? And when you see LER that's either really good or really bad, it makes you look at those four things. So if it's really bad, do I have the right person? Maybe I have a really high priced person when I could have used maybe two. Maybe instead of like senior people, you use associates. Then the right seat, it's like, is that person making a lot of money doing downright work? And then you have the work they're actually doing. Are we actually billing high enough for it? Or maybe we're underpricing on a service. And so that labor efficiency number brings about several questions that make you examine the inner workings of your business in ways that as me, I've been doing this for a while, as ways when I started going, wow, that number right there makes me ask all kinds of questions. It's not just, is my labor inefficient? Is the things around the labor potentially inefficient as well?
Are you finding in this age of AI that we're living in, and depending on when you're listening to this, maybe robots are doing all of our jobs now anyway, and none of this matters anymore.
Right.
You're just listening to this for fun. It's like a history lesson. But in this age of AI where, I just a few weeks ago created myself, and I'm not a programmer, an app that is better than something I spent 10 grand on and took a month of a developer's time. I did it myself in about 3 hours. There's some amazing things, some scary things too, but some amazing things we can do in AI. Are you finding that people are raising their LER targets because they're able to be more productive because of all the opportunities AI brings? Or are you not quite seeing that linkage yet?
From my experience, the clients that I work with are heading towards that. They haven't fully got there yet. So what I'm saying is that they maybe purchased the AI, components to help them do that, or they're working that in. They haven't got there yet, but it is a major. I don't have one that isn't a major initiative in 2026 is to get that implemented. And so, yeah, it's going to happen.
I would say the same. I mean, there are a handful of cases to where something has been completely automated and the human labor has been removed. And I haven't seen a lot of cases to where folks have downsized because of it. They have been able to grow and not have to add talent, or they've been able to take that talent and move it to other areas. Mike, I kind of compare it to when computers first came out. When they become more widestream and popular, there was a time period there to where the early adopters were able to do some things, and it would just blow your mind away, right? I mean, the calculations they could do, and using Lotus 1, 2, 3, and this, that, and the other, and it's so much faster. But there was a learning curve, and it took some time for everyone to fully understand how to use the tool. And in some cases, they spent as much time trying to get the tool to do the work and do it properly as they did just doing the work the old way. And that slowly started to erode after, the technology improved. I think that's kind of where we are in a lot of instances with AI. It's definitely has some pretty substantial impacts and potential for impacts. Is it being widely used and a large deal of efficiency generated? Not just yet, but it's coming.
Yeah. So I want to shift focus from labor efficiency to cash flow. So we mentioned before this, revenue is vanity, profit is sanity, cash is king. And I find when I'm working with a leadership team, they've got their P&L,
right?
And some are sharing, some not. Most are sharing it. But when we start to talk about cash, people's eyes glaze over a little bit, or they get confused. Look, even the CFO, I'm like, all right, I understand what your margin target is. I've got, your EBITDA target, we've got that. But, what about cash flow? Like what is success in cash flow? And they're even the CFOs are sometimes confused about how they should measure it. So how do you suggest leadership teams, CFOs, how should they be thinking about measuring, monitoring, setting goals and targets for cash flow?
So, Mike, I'll have to start with a quote from one of our clients about cash flow because I think this really summarizes it. He says, "Cash is like my waiter when I'm waiting on the check. They are nowhere to be found." Profitable business, it's running, everything's great. You look at the bank account and you go, where'd the cash go? What's happening here? And so I'll give you a couple things we like to look at. Obviously, when we talked about with profitability and the levers and what have you, it's really important to understand the impacts of an activity on the P&L and what that's going to do on your cash as far as cash flow. And that, like I said at the very beginning, I mentioned the ripples of a great leader. Cash flow is like the ninth and 10th ripple. A great leader can kind of look at it and go, oh, if we bring this new service or product to market, here's what it's going to produce. But can they walk that all the way through to the cash flow implications? Because it could be great for profit and terrible for cash flow. So what do you want to look at? I'm going to start with this concept we call trade capital. So if you Mike mentioned the Simple Numbers book. We have two books, Simple Numbers, Straight Talk, Big Profits, and then the second one is pretty creative in name. It's Simple Numbers 2.0. If you look in Simple Numbers 2.0, we talk about this concept that we call trade capital. So when you're running a business, there are certain things from a cash flow perspective that you have to fund inside that business. So I'll give you two examples, two most common. Accounts receivable. Let's say you're a service-based business. You work for 30 days. You pay your rent, you pay your employees, pay all your marketing expenses, pay all your general overhead. At the end of those 30 days, you send that client an invoice, and they have 30 days to pay. So for another 30 days, you pay your team, you pay your vendors, you pay everyone. We're 60 days into this of you paying for everything, waiting on that receivable to come in. So we call that funding receivables. Most businesses have that. Okay. So that's something you have to fund inside your business. You need cash for that. The second most common one is inventory. Whether you're manufacturing or you're in retail or in distribution, you have to go buy the product or the materials. You have to sell it or produce it. And then hopefully you get paid at that time. Not always, but hopefully you get paid at that time. Well, that might be a 30, 45, 90-day process. So you have to fund the inventory inside your business. There can be a handful of other little things like prepaid expenses and what have you that you have to fund. So think of the things you have to cover inside your business. And then there are things that others cover for you. You get terms on them. So some of your vendors give you terms. They give you payables, right? So on those supplies and materials I mentioned earlier, you might have 30 days before you have to pay them. Others, you might only have 15 days. Your landlord may give you 2 days, right? So those are things other people fund for you. You also get to use a credit card, right? So you get to rack up all the expenses and get all the miles and all the fun stuff there. And then you pay 30 days later. So if we look at what you have to fund in your business minus what other people fund for you, that gives us what we call trade capital. Okay. Now that number in and of itself doesn't have any connotation to it. But if I compare that trade capital to a percentage of my annual revenue, and let's just say it's 6% of my annual revenue, and then I compare my profit to a percentage of my annual revenue, and let's say that's 4%, I got a problem. It takes more capital to fund the business than I can generate in profit. And doesn't mean I'm not profitable. It just means it requires more for me to cover up front. So now anytime I grow, I've got a gap, I need capital. On the other hand, it could be my trade capital is 6% and my profit's 10%. Well, guess what? You generate cash. Whenever you grow, you add dollars to the bank account. And so that's a very high level understanding of it, but it kind of helps you to know very easily, do I have a cash flow profile that requires capital to grow or produces capital when I grow? And I then can start to use that information in making decisions. And you can even break it down by activity. You can say, okay, if we were to start offering this new service or product, what kind of trade capital requirement is it going to produce? And am I going to be, as it grows, is it going to eat cash or is it going to produce cash? Mike, any thoughts on that before we go through the next one?
Yeah, I just think that how people get creative in getting their dollars in quicker is the key point of that trade capital signature. And everybody, hey, it's nice. I want to give 30-day terms, but maybe you can give 15 and they can pay you quicker. Maybe, hey, write down the credit card. We auto charge every month. Or, hey, it's just due upon receipt. Or we bill it. For example, I got a couple of law firms I work with where they were billing their clients just once a month. And so the invoices went out on the first. Well, I'm like, how about every time you got a new client, you send those out for the new ones on the 15th of every month. And now we got stacks of cash coming in at different times on a better cycle of money coming in the door. So the trade capital that Brandon's referring to, when it's looking at, hey, how do I improve my trade capital? Just get that money in the door quicker, upfront, deposits, whatever you need to do. That'll address that trade capital issue pretty quick.
Yeah, I think a great example. It's an old example, but I think it's a good one. Although you guys will tell me, because what we're talking about to some degree is like shrinking the cash conversion cycle.
Right.
Correct.
And,
Yep.
and the story I always used to tell was Dell.
Oh, yeah.
Back in, I don't know, is it the 90s
Yeah.
but when they went from, way back, the way people used to buy computers was you'd go into a store and buy a computer, and Dell had to make that computer, get it out to CompUSA or whatever they were selling computers back then. And they may fund that whole computer, build the computer, and they may not see that money back from the retailer for another 60 days.
Right.
When they changed their business model to be one of the first places to go online and have people go in and customize the computer they wanted, but what did they do right before they left the website after they ordered it? They paid for the damn thing before Dell even built it.
Yeah.
And in some cases before they had the raw materials. So they went from a cash conversion cycle of 60 days or whatever it was to a negative cash conversion cycle, which means they were actually bringing money in before they had to get money out. And am I
That's
right
it.
in saying
Oh,
that
you're
that's
spot
an
on.
idea? Yeah.
They would have negative trade capital or very low trade capital.
Yeah.
And as you kind of look at what are some moves that you can make to achieve that, Mike mentioned, can you bill faster, those kind of things, without a doubt. We've got a client who, if you want to buy their product, you pay for it up front. The industry norm is that we pay you in 30 days. And so everyone goes, well, how did you pull that off? And he said two things. The first is that we asked. If you don't ask, the answer is always no. And secondly, we deliver a product that's superior to everyone else's. So if you want the best, that's how it works. So you got to be able to very effectively communicate that competitive advantage. Most companies can't do that. If you can put those two together, you can go a long way. And then the other way is, let's say you're dealing with the bigs, as we call them, the Apples, the Googles, GE, these massive conglomerates. Well, you can tell them you're going to have to pay half up front, and they're going to tell you have a Coke and smile. And you can tell them how much better you are, and they go, I don't care, right? And so that's where many times you go to your vendor partners and you go, hey, I got this massive contract with Apple, and here's what they want, and here's what I need from you. I'm going to make a massive order with you, but you got to help me in this. I can't be the bank on my own. We have what we refer to as a us problem, not a me problem, right? And many times your vendors are willing to work with you, but you got to go and ask and talk to them. And those are just a handful of ways. There's some other things that can be adjustments there with trade capital to help improve it. And of course, getting profitability up is the other one, because if I'm more profitable, then as I compare those two metrics, I generate more in profit to be able to cover that cash flow gap. The other metric is what we would call core or buffer capital, which is basically your sleep well at night number. How much cash do I need to have on hand? Not every business is going to be able to hit this because some just have an extremely high trade capital requirement. They got to carry a lot of inventory and they carry receivables. I'll tell you, if you have to carry inventory and you have receivables, it's a really tough game when it comes to cash flow. But if you don't, what you need to aim for is I need 2 months of OPEX and direct labor, a zero balance on my line of credit, and my taxes set aside separately. And that data point came from studying thousands of businesses. And what we found is we plotted out their cash flow cycles is that if you had that 2 months OPEX plus direct labor and 0 on your line of credit, your taxes set aside, the market could throw just about any storm it wanted to at you and you would survive. You have plenty of runway. On the flip side, if you have that amount of capital, you can go do some really fun things. You can look and say, hey, I want to try a new marketing technique. I want to launch something new. I want to take a risk on a salesperson. I want to expand into another territory. Well, if you have that capital, you can make those bets. But if you don't have that capital, you don't get a choice.
Yeah, and I've seen too many companies put in a situation where they have to make dumb short-term decisions based on the fact that they just don't have enough capital to make the right decision, and it kills them. And it's, you know, it's the most important thing you've got is how much cash you've got, and it's the thing that most leadership teams screw up in terms of measuring it. They figure, well, if I'm profitable, everything's going to be okay.
Right.
And
most of the time, if you're a solid business that is profitable, but it's growing and you have a large amount of trade capital requirement, I mean, you got to buy inventory, float receivables, those kind of things, right? The bank or a lending partner typically will work with you. You can make a pretty good argument. It becomes a great win-win. If you're not profitable, good luck. And that's why that labor efficiency is so important, and that salary cap is so important, and why your leadership team is so important, because you really start getting your hands tied whenever that happens.
both of you work with, and others in your organization, you work with a lot of, you know, founder-led, owner-led, entrepreneurial types of companies. And, you know, I see in my work, I work with a small number of companies in a really deep way. So it's hard for me to see the bigger trends. I can tell you what's going on at my companies, but you guys see a lot more companies. So what's going on these days in kind of the entrepreneurial economy that may be important for us to know about?
Mike, we could talk 2 days about this, and I love it. I love it. So a little background. We have a model that we track that has 100 of our clients in it going back pre-COVID. I think it actually goes back to like 2018, 2017, somewhere in that neighborhood. And to our knowledge, it's some of the best information available around how entrepreneurial companies are performing. Because if you think about it, that data is not readily available. You know, right now, what does the government know about your business? Very little, if anything. They probably know what payroll was from your last payroll tax
we
return.
want to keep it that way.
Oh,
Yes.
no doubt. And sometimes this year they'll find something out when you file a tax return, depending upon how accurate all that information is, right? But this is data that's coming right from under our clients, and so we've cleaned it up in terms of, you know, it's accurate, it's correct, and so it's geographically diverse. It's across the country. It's industry diverse, multiple industries. It's from companies that are $2 million to $100 million, right? So you put all these together and you look at them as one big company. Here's what we're seeing. Revenue continues to grow. It's somewhere between 8 and 10%, typically speaking, is kind of what you're seeing year over year. But what did we talk about earlier? Revenue is what?
Vanity.
Vanity. Profit has been flat to declining. So I'm going to give you a data point here that's going to blow your mind. If we go back to 2021, those 100 companies have increased revenue by $300 million. Profit is unchanged. Okay. And you go, wow. Well, the increased revenue, most of that revenue increase was through pricing, inflation, right? Profitability is not changing. It is a difficult marketplace, without a doubt. Now, there's a couple of things, if you dig a little bit deeper into the data, that start to show that are really interesting. So the first, in the current marketplace, and I'd say this has been the case for about the past 12 months or so, what you do is more important than how you do it. Okay? So let me explain that a little bit. You can be one of the best online retailers or best mid-level restaurants out there. You can be operationally efficient. You can follow everything to a T. It is going to be extremely difficult for you because consumer spending is tight. People just don't have the extra money to go spend on a discretionary item. Okay.
If it is a business that people can defer or they have a deferred mindset with it, I use examples of trees. If you're a company that cuts down trees for people, residential tree care or something, like, look, unless that tree's roots are wrapped around my pipes, I can wait a few months to do it. If I want to build that shed, I could wait a few months potentially to do it if it's, just something I wanted to do. Anything that is adopting a deferred mindset has been an issue.
Yeah. So if you're in a necessity type of business, so think like plumbing, HVAC, those kind of things. Hey, if the toilet's clogged, it's got to be fixed. It doesn't matter if you're getting no overtime. It doesn't matter if I didn't get my 40 hours this week. It doesn't matter if I'm not getting a bonus. I got to fix it. So those businesses are actually doing quite well, even if they're not operationally as great as some other businesses out there. So that's the first thing that really stands out in the marketplace. The second thing is the difference between companies that are 100 million and above in revenue. 10 million and above in revenue versus those that are below 10 million in revenue. If you're below 10 million in revenue, it has become extremely difficult to leverage operating expenses, and in many cases, extremely difficult to actually grow top line revenue. So those bucket of companies, we're seeing them down in profit from 24 to 25. Our data's through December of 25. They're growing by less than 1% in top line. And you look at that and you kind of go, why? Why is that the case? Well, we got some theories in looking and talking to those clients. So the first theory is just kind of the economies of scale. If you send 3 people to a conference and a competitor that's $20 million sends 3 people to a conference, it's the same cost, but it's much more expensive to you as a $2 million business, right? And so as inflation continues to impact overhead spend, they're just not able to absorb it. Secondly, when you look at leadership teams, for companies that are above 10 million in revenue, they typically have a stronger, more diversified leadership team. And so when it's difficult to go and get a sale, when it's difficult to figure out your competitive advantage and communicate that effectively, when it's operationally more complex, you need that level of horsepower in the current marketplace to compete. And they're doing it. They're taking market share.
Are you seeing a difference, I guess, from both of those standpoints, from that 10 million level you talked about, and also the revenue growing, but profit not growing, and profit as a percent of revenue shrinking?
Right.
Are you seeing a difference between B2B and B2C? Some of the examples you gave, the HVAC company, the company that's cutting down trees are more B2C examples. Are you finding the same thing in the B2B world?
Yeah, if it's a discretionary service, B2B, it's still tough. Maybe not quite as tough as B2C discretionary, but it's still really difficult. I don't consider this a discretionary expense, but a lot of entrepreneurs do. Marketing's tough. And the companies that are not growing, marketing is down 7%, and the companies that are growing, marketing is up 10%. So things like that, they're cutting. Insurance, it's a necessity. You got to have it, right? Insurance is going up 15 to 20% in most cases. So, yeah, I would say, Mike, that it might be a little bit more difficult if you're B2C, just because there's less flexibility with consumers than there are businesses. But pretty much anything discretionary is tough.
So interested in your takeaway from all that. I'll tell you what my takeaway is, and you could challenge mine or agree with mine or not, and then add your own. My takeaway from what you just said is that doesn't mean, well, I guess if you're listening to this and you're a business leader, you're shit out of luck. That's not what it means.
No, not at all.
What it means is, in order to be successful, you better be doing everything you can to know your financial health, to be able to project your financial health, to be able to make the right decisions on labor, and the other big spends. And that's all your world. And then from my world, you better be surrounding yourself with not only people that get you to your labor efficiency numbers, but you better be surrounding yourself with the right people, because mediocre ain't going to cut it.
Yeah, mediocre will put you into bankruptcy right now. No doubt
Mhm.
about it. I mean, there is no margin for error in the marketplace. Used to from let's call it 2009 to 2021, 2022. If you're CRO, if you're your revenue manager, whatever you want to call them, if they weren't doing a great job, it didn't even show up because there were so many people lined up to buy your service or product. It masked it, and now it'll stick out like a sore thumb. So, in the current marketplace, we love to say you have to be profitable with what you have. Meaning, at your current level of activity, you got to be profitable. It's really difficult to grow into your footprint. Meaning, I got a couple extra people. We're just going to absorb it and grow into it. I can't tell you the number of folks that are running losses every month, buying hope that they're going to be able to grow into it. It's really difficult to do that. So you got to be profitable with what you have. You have to have tight control over the business. Like I said earlier, the days of it being easy are gone. As Warren Buffett said, it's when the tide rolls out whenever you find out who is swimming with no shorts on. Well, if you don't have great control right now, you're going to be one of those folks that has no shorts on.
So I want to repeat. I want to repeat what Brandon just said, because it's so important. And I see, my clients falling into this trap all the time. As leaders, we're very optimistic about our businesses. We believe this, and that's great. I hope you are. But the days of saying revenue is going to solve my profitability problem, which is always the first place people go, how are we going to increase revenue to solve the profitability problem? It's like, yeah, increase your revenue. Let's figure that out. But don't do it to solve your profitability problem. Solve your profitability problem at the current revenue. And it's just, it sounds like an obvious, logical thing, but it is not. People want to solve their profitability problem by increasing revenue by 25%. And yeah, go increase your revenue by 25%. That's great. But that doesn't mean you've solved your profitability problem.
Exactly.
One of the things that I try to hone into people to help this, and I'll try to make sure everyone visualize it. So imagine a wheel, and this can move real fast or real slow. But we call it our simple numbers playbook when we work with clients and engage. And Mike, this hits right on your point. You got to assess the market conditions for profitability and scale. You got to clear distortions. Number 2, we're moving around the wheel. Then get profitable with what you got. What comes after that? Get capital efficient and get fully capitalized. For those out there that you got to stack cash is what I'm trying to say. And then come around to that wheel. How do we use that cash, grow, or do we hold on to it to then make a big play in the market for some sort of action? And so you move around that wheel. And what Mike was saying there and Brandon is, hey, how's that market looking for us right now? How is everything in our data? Have we fixed our labor efficiency? Have we done the right things within our current data set? And then are we profitable can we get there? Can we get to double-digit profits, 10, 15% with that? And then, hey, get the cash, move back around. What do we do with it? And you just move around that wheel. And you got to ask yourself, in a market where we don't have a lot of market growth, so it's a lot of people going after market share, you're really digging into each one of those points on that wheel there of going, hey, can I get it? Can I get that here? Or can I get profit and just hold my cash until, bam, I can make a major play to beat my competition?
So as we start to wrap this up, I'm hoping what you're taking from this as a listener is, there were certainly some specific concepts that I hope you grab and learn from, like labor efficiency ratio, like the idea of trade capital and core buffer and all that stuff. But in addition to that, I hope, and I think more importantly, what you take out of this as a leader is that you got some work to do. And maybe a more positive way to say it is there's some real opportunity,
no doubt,
to understand your numbers at a much more actionable level than you probably understand it, to make sure your leaders understand how they can take actions based on the numbers, whatever numbers are important to them as well. That's what I hope you're getting from this, is saying, oh crap, you know what? There's a lot of opportunity. I've got to dig in and understand this more. And that being said, let me ask you guys if, as people say, hey, there's an opportunity here, I've got to dig in. You've mentioned both of your books, Simple Number 2.0 and the older books, Simple Numbers, Straight Talk, Big Profits. Where else should people go if they want to find more out about you, your company, and how you might be able to help them?
So a couple places, obviously you got the website, right? simplenumberscri.com. Mike was on a podcast with us a couple of weeks ago. And so the Simple Numbers Profitability Playbook is another great place to go and get some chunks of information and hopefully some things that can help you improve as an entrepreneur and run a better business. And then, got myself, Brandon Gray, and Mike Maxon. We're both active on LinkedIn. So you can message us on LinkedIn as well. But, I think one of those three ways is probably the easiest way to either learn more or find out more about us.
Beautiful. Well, I always say, if you want a great company, you need a great leadership team. Understanding your financials is a big part of that. So Brandon, Mike, thanks for helping us get there
Thank
today.
you. It's been great.
Thank you. Appreciate it.